the MPC decided by a majority of 4 members out of 6 to increase the policy repo rate by 25 basis points to 6.5%.
Simple terms, for the Aam Aadmi, it is going to be a huge blow now, because now the EMIs will get expensive, and this has happened because of the rise in inflation.
The headline from the Reserve Bank this week was Reserve Bank has raised repo rates by 0.25% to 6.5%.
So for the Aam Aadmi, there is some pain towards the oil prices, food articles are expensive, and now even the homes are likely to get expensive. Now, this has happened first time in over 4 years that we have seen a hike in interest rate coming in.
What's up, people? As we just saw, since May 2022, the Reserve Bank of India has been constantly hiking the repo rates with a total increase of 2.5% in the last 12 months. Now, usually a hike in the repo rate is brought in as a measure to control inflation, and accordingly is seen to have multiple effects. As a result, the last year witnessed loans getting costlier, with either the EMIs going up or the overall loan tenures increasing, whether the loans were obtained for personal use or business use. Borrowers across segments experienced a hole in their pocket with the rising interest costs. With everyone expecting this repo rate to further hike as a measure to combat inflation, the RBI, surprisingly, in its last meeting held on 6th April, decided to keep the repo rate unchanged at 6.5%. Yes, the repo rate increase received a much-deserved pause.
India's central bank surprised investors after it chose to hit the pause button on the interest rate hike, with speculation about the interest rates reversing in future.
Let me read this sentence again. The Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6.5%. Let me emphasize that the decision to pause on the repo rate is for this meeting only.
Now, although this measure comes as a relief for the existing and new borrowers, it doesn't imply that the loans will become cheaper, but rather will maintain their existing rates. But apart from loans, the repo rates also seem to have a very charming effect on one another financial product, that is fixed deposits. So in this video, we will understand how does a hike in the repo rate affect the interest rates on fixed deposits, and whether or not this is the right time to invest in FDs. But before that, let us understand what is repo rate. For those of you who already know about repo rates, you can skip to this timestamp. For the rest, let's hear it out. Repo rate is the interest rate at which a central bank of a country, in this case RBI, lends money to the commercial banks. Let's understand this with the help of an example. See, Sushant needs $2 million to expand his business. He goes to a bank, offers his house, the Bindal Mansion, as security, and gets a loan of $2 million at an interest rate of 10%. Similarly, a bank also needs funds to run their business. But unlike Sushant, commercial banks go to the central bank for their funding requirements. Now, the central bank, that is RBI, also offers these loans to the commercial banks in exchange of some security, say treasury bills or government bonds. And the rate of interest at which the central bank offers these funds to the commercial bank is called as the repo rate. I hope you're now clear on what repo rate exactly is. So let's move further to understand how does an increase in the repo rate affect the interest rate on fixed deposits. But before that, if you enjoyed this video, do hit the like and subscribe button. So if a bank has to lend money to the borrowers, they have two sources of funds. The first is, as we discussed above, borrowing money from RBI at repo rate. But for that, banks need to pledge certain security to the RBI and also need to adhere to the statutory limits while borrowing funds. The second and the much easier resource is directly calling money from the public in the form of fixed deposits from people like you and me. But why would anyone be motivated to invest in an FD? Let's find out. So whenever there is an increase in the repo rate, there is an immediate increase in the interest rate on loans as well. For the sole reason that if the rate at which banks borrow money from RBI is increased, the rate at which these banks will further lend money to the customers also increases. And this reason is not only seen in new loans but on the already issued loans as well. Thus, the banks have surplus interest earning in their hands. Now, in order to encourage investment in fixed deposits, the banks pass on the benefit of this surplus interest to their deposit holders by increasing the rate on FDs, thereby making it lucrative for the investors. After all, who doesn't want a fixed deposit with high interest rates? So, does that mean that an increase in the repo rate is followed by an immediate increase in the FD interest rates? No. I'll explain. The interest paid by the bank to us on a fixed deposit is an expense to the bank. Therefore, an increase in the FD rates will lead to a direct reduction in the net income of the banks. Now, as per the normal business prudence, one must always minimize their expenses and postpone it to the farthest times. That is why, instead of directly calling funds from the public, banks first use their existing liquidity to provide loans to their customers. It is only when the loan requirements of banks increase to a level where they exhaust their current liquidity, banks call for money from the public by offering higher interest rate on these deposits. This way, the banks maintain a healthy balance between the loans given to the public and the deposits accepted from the public. That is why, although the interest rate on loans increase immediately after a repo rate hike, it takes a little while for this hike to reflect on the FD interest rates as well. And this time difference or the process between the hike in the repo rates and the subsequent hike in the FD rates is what we call monetary policy transmission. Sorted? Okay. Now that we've understood how the repo rate hikes affect the FD rate hikes, let's move on to our third and final question of this video, whether or not it is the right time to invest in FDs. But before that, if you haven't already liked this video and subscribed to my channel, you can do it now. From the onset of COVID until May 2022, the repo rate remained unchanged at 4%. However, in May 2022, it was increased by 0.4%, bringing it back to the pre-COVID levels of 4.4%. And if you see, the rates have been ever increasing since then. Now, the last hike was announced by RBI in Feb 2023. Bringing the repo rate to the current levels of 6.5%. Naturally, considering the world economic trends and rising inflation, everyone expected RBI to increase the repo rates further in April 2023. However, to everyone's surprise, RBI decided to give the repo rate hike a pause, which exactly is the reason of our today's discussion. Now, although the rate hikes have come in as a gradual increase, if you look at it holistically, the repo rate has increased by a total of 2.5% in the last 1 year. And this current rate of 6.5%, which was last observed in August 2018 and before that in April 2016, has been the highest in the last 6 years. Now let's compare this increase in the repo rate with the corresponding increase in the rate of interest on fixed deposits. Assuming the period of monetary policy transmission to be 4 months, let's take a look at the historic FD rate chart of State Bank of India from September 2016 till date. So as you can see, the interest rate on a normal fixed deposit was the highest in September 2016 at 7.25%. That means that when the repo rate was at a peak of 6.5%, the FD rates peaked after 4 months at 7.25%. Now currently, SBI is offering a 7% interest rate on a normal fixed deposit, which is just 0.25% away from its last peak. In fact, some banks are also offering an FD interest rate of 8%, along with small finance banks offering a rate as high as 9%. Also, when we talk about an overall increase in the last 1 year, SBI has already increased the FD rate by a total of 1.5% as compared to a 2.5% increase in the repo rate. So as you can see, a major part of the repo rate increase has already been passed on to the FD interest rates. You might think that there is still a possibility for these FD rates to further increase by 0.25% to match its September 2016 peak. Also, considering the RBI has only decided to pause the repo rate hike, one can still expect a repo rate increase in the coming months, which in turn will increase the interest rate on fixed deposits even further. But here is where things turn interesting. Now, just before the RBI decided to announce the stance on the repo rates remaining unchanged, Finance Bill 2023 was passed, which brought in a major change in the taxation of debt funds. That is, the removal of indexation benefits while calculating the tax on your income from debt mutual funds. Now, because of this change, the post-tax returns on a debt fund has become more or less equal to a post-tax return on a fixed deposit. The only difference being that fixed deposits still give you a guaranteed return, which debt funds don't. And because of this move, banks can now expect a major set of investors to take an exit from debt funds and move their investments to fixed deposits without offering any further hike in the interest rates. So if you are wondering whether the FD interest rates will increase any further or not, I hope the above analysis can help you take a better decision. If you think that the FD interest rates have achieved their peak, hurry up and book your FD now. And for those of you who are expecting a further hike in the FD rates, well, you can always book a short-term FD using the current peak or offer FD laddering. Now, what is FD laddering and how can you maximize your returns on FDs? We shall learn all of it in my upcoming videos. Meanwhile, you can use the research material in the description to understand the topic better. I would love to discuss your point of view in the comments below. But before you go, don't forget to like this video and subscribe to my channel, The Unconventional CA, for more such brainstorming sessions.